don't freak out. If there's one thing that you take away from this video after all of the craziness that we've been through in the markets in the last couple of weeks, then please let it be that. And I know this is a lot easier said than done, especially with all the headlines like every single day pretty much. Still, it's really important. This is probably the most important thing that you could be doing right now. And so in this video, what I'm going to be talking about is why it's important to sort of keep your cool, but also help you put a lot of that in perspective. Like, it's important to stay calm because it's honestly not that big a deal. And then the second thing is how to actually keep your cool, how to set up your portfolio so it's in good shape. Hey guys, Jessica here. Before jumping into it, really quick call out that we're Uprise. We're a fintech company that puts together personalized Wall Street level financial plans. And we take a look at people's specific situations. So student loans, budgeting, employer benefits, and we take a look at the entire picture to figure out how to optimize. So to get your plan, definitely check us out. I've linked to us in the description below. Also wanted to ask, please give this video a thumbs up, hit that subscribe button. It really, really helps small channels like ours. Getting back to it. So before I talk about, what you should do, how you should handle the crazy market movements that we've been seeing, I wanted to rewind a bit and talk about actually what market corrections actually are, because not all declines are the same. Let me explain. 3 terms: a market correction, a market crash, and a bear market. So if an asset falls in price by 10% or so from its most recent high, that's a correction. And corrections can happen with an individual stock, a broad market index, a commodity. Basically, all of these kinds of things can have price corrections. And generally speaking, what triggers it could be anything from, a change in outlook in terms of the economic prospects. It could be the Fed making a change in policy or a political issue. There's a whole host of reasons why people might change their opinions about the future of a particular asset. On the other hand, a crash is usually double-digit declines, and they happen a lot faster. So, for example, in 1987, on Black Monday, the Dow Jones Industrial Average fell 22% in one day. And so corrections usually are a lot slower to happen, and very frequently people think it's actually a good thing because it helps prevent the market from overheating. That said, if that decline continues to, say, 20% or more, then we're in a bear market. And a bear market, in addition to having a pretty large magnitude, also is longer in duration. And that's normally because it's reflecting something that's going on in the economy overall, like a recession. And recessions mean 2 or more quarters of negative GDP growth. Just a quick terminology lesson that I found to be pretty fascinating. But if there's one takeaway here, I think it's that, it's impossible to predict the future, as always, with markets and investing. But also that corrections are normal and can even be a good thing. So that brings me to, how do we handle it? What do we do about it? Step 1 is not to panic, as mentioned. I know it's really easy to feel like this. But just remember, we're investing for the long term in assets that we believe in. And so short-term market corrections happen all the time. Hopefully it will just be a blip, in terms of our returns in the grand scheme of things. And so along those lines, it probably doesn't make sense to be glued to your brokerage account or your portfolio or the markets page on Google. Rather, I recommend that you set time reminders. So specifically, only check your portfolio once per week or even longer than that. And the key thing here is money is such an emotional topic that we have to do really deliberate things to keep ourselves sane. And in fact, if you have a 401k or an IRA, you're saving for retirement, I definitely recommend, thinking about buying more into the market when it drops. Think about it this way. Stocks are basically now on sale. They're cheaper now than they were before. And so you can have the opportunity to buy at a lower price. Hopefully that means you have higher returns than if you were to buy it, when the price was way high. On that topic of staying sane though, I'm recommending that you buy in when the market drops, but I'm not recommending that you try to time the market for when you think it's going to bottom out, because that is just, oh my God, that adds even more stress. So the idea behind this is you should dollar cost average. Dollar cost averaging means that you put into the market fixed amounts at fixed intervals. So for example, you say, I'm going to put in $500 every 2 weeks, and then you stick to that. Even if the market's moving all over the place, you stick to that strategy. There is no better way to keep emotions out of investing, and also to get the benefit of potentially lower prices over time. And in fact, you can even set up your direct deposit to automatically invest into the market for you. We did a separate video about how to put your investing on autopilot, how to put your finances on autopilot. I'll link to that up here. And that's it. If you have any other questions about how to deal with stock market craziness, definitely let us know in the comments below. Also, if you like more support with personal finance, definitely check out Uprise. I've linked to us in the description below. As mentioned, we put together personalized Wall Street level financial plans completely and 100% for free. So if you have any questions around student loans, employer benefits, investing, whatever it is, we'd be happy to help. And on average, we put 100K in net worth back into people's pockets. Other than that, if you'd like to see more videos like this one, please give us a thumbs up, hit that subscribe button, and click the bell for notifications. See you guys next time.